Welcome to the Financial Summaries channel, where we provide quick summaries of earnings calls. Let's start with a quick summary of the key takeaways from HDFC Bank's Q4 FY25 earnings call. Positives. Strong deposit growth. Deposits grew faster than loans and the system, bringing the credit-to-deposit ratio down to 96% from 110% post-merger. Stable asset quality. Asset quality remains pristine with no major stress across segments, including unsecured lending. Productivity focus via reorganization. The commercial and rural banking division was reorganized to drive cross-selling, deepen reach, and boost efficiency. Negatives. CASA ratio pressure. CASA growth remains under strain, with higher reliance on term deposits and low disposable incomes at the bottom of the pyramid. Margin compression risk. NIMs remain in a tight band but face headwinds from repo rate cuts and slow deposit repricing. Return on asset ROA capped and limited guidance. Management avoids offering firm guidance on 2% ROA. Structural upside could be capped due to continuous reinvestment needs. Detailed breakdown. What the management said. MD and CEOs Sachidhar Jagdishan opened the call with optimism about India's macro environment, lower inflation, an accommodative RBI stance, and potential rural and consumption uptick supporting GDP growth in FY26. However, global uncertainties around trade tariffs continue to be a watch factor. Deposit and loan trends. One of the bank's biggest wins this quarter was its credit-to-deposit ratio, CD ratio, improvement. From a post-merger peak of 110%, it's now at 96%, a sign that deposits are outpacing loan growth. The bank reiterated its focus on balanced, quality-led loan growth, net interest margins, and NIMs. CFO Srinivasan Vaidyanathan highlighted that NIMs remain stable in the 3.43% to 3.46% band, driven by tight control over borrowing costs and portfolio mix. While repo rate cuts have begun, their full impact on NIMs will be felt in Q1 FY26. We manage margin through pricing discipline. Repo-linked loans adjust quickly, but deposits take time, Srini explained. CASA and deposit strategy. CASA remains a concern. CASA growth lags as customers shift to time deposits amid high interest rates and weaker savings power. HDFC Bank believes that CASA typically recovers with a lag after rate cuts, but no quick turnaround is expected. Despite this, the bank does not believe in aggressive deposit pricing to win share, calling it a short-term tactic. Instead, the focus is on distribution reach, branch expansion, and RM engagement. Commercial and rural banking, CRB, reorganization, and rural push. With Rahul Shukla on sabbatical, the commercial and rural banking, CRB, division underwent a major overhaul. The goal: integrate agriculture, gold loans, auto loans, and more under a single team to cross-sell, drive productivity, and optimize field efforts. We are reorganizing to unlock synergy. One team can now offer loans, auto finance, and even gold-backed credit to rural customers, said Srini. This is expected to enhance touchpoints and improve rural penetration across HDFC's 2.25 lakh plus village network. Priority sector lending, PSL. The bank reported a 1% shortfall in meeting the mandated PSL sub-targets, like small/marginal farmers. This is being covered via IBPCs, PTCs, and if needed, RIDF investments. Management indicated that cost impact is neutral across these methods. Return on assets, ROA. The bank continues to defend the 1.8 to 1.9% ROA, saying 2% is not a formal target. They expect cost efficiencies to improve as branch and tech investments mature. However, Srini cautioned, we operate within a band. ROA could fluctuate by 5 to 10 BPS, but won't move dramatically. Asset quality and credit risk. On NPAs and credit cycles, both Srini and Sashi were confident. We won't chase volumes by compromising credit quality. We maintain a flat loss ratio across decades, they emphasized. Even in the SME space, they see opportunity but will not loosen credit filters. Instead, they aim to deepen full banking relationships rather than just pushing loan products. Technology and operating leverage. The bank has made massive tech and branch investments over the past 5 years. Now, it's time to harvest the productivity gains. Srini hinted at improvements in cost to income and cost to assets going forward, though benefits will be gradual. To recap, here are the 3 positives and 3 concerns again. Positives. Strong deposit traction helped improve CD ratio. Asset quality remains robust despite macro noise. Rural growth strategy with cross-sell and digital focus shows long-term promise. Negatives. CASA mix remains a drag and may take time to recover. NIM compression risk due to repo rate cuts and lagged deposit repricing. ROA upside may remain capped as tech and infra investments continue. As HDFC Bank enters FY26, all eyes will be on its CASA revival, margin defense, and execution of rural and tech productivity plans. If you found this helpful, don't forget to like and subscribe for more earnings breakdowns and share with people who might need it.